Well, related to the dollar in many ways is the price of gold, which is through the roof. But in this week's Best in Class segment, a top-performing metals fund manager says that matters less than you might think. He's Dan Denbow, co-manager of the USAA Precious Metals and Minerals Fund, which has outperformed 90% of its peers over the last 5 years. And he joins us from San Antonio, Texas. And Dan, thanks so much for being with us.
Thanks for having me.
Okay, so you run this gold fund, but you're agnostic on the price of gold. How can that be?
Well, what we try to do is we try to manage the fund in a manner that we can do well when both gold goes up and down. And it's by focusing on our three core pillars, which is growth, quality of the management, and valuations. We hope to outperform both in up markets and down markets our peers, so we run it on a relative basis.
But surely it must help, though, that it keeps hitting records.
Oh, certainly. And we love the market, the gold market to go up. It definitely helps our companies. We invest only in mining companies which have operating leverage, and therefore, as gold goes up, our stocks have a beta to that rising gold price.
But in a way, though, I guess the downside to that, I presume, could be that if everything goes up, if gold is going up and up and up, how do you differentiate then when you're looking at stocks? Who are the top performers and who are those that are just riding this momentum?
Yes, and that's why we focus on looking at companies that have growth, the quality of the companies, low-cost miners, and then the valuations, and focus on those that look relatively more attractive than others in the market. But those that ride the wave up will ride the wave harder going down, and therefore we try to avoid those kind of stocks and just the ones that are doing things to grow the companies.
Okay, so on the defensive side then, when the gold price or metal prices go down, you look at companies like Silver Wheaton and also Royal Gold because they have these royalty arrangements, right?
Right, they're not exposed to operating costs, and therefore when prices come down, their operating leverage doesn't fall as quickly as some other of the miners. Focusing on low-cost producers is one of the key things you can do to benefit on the downside. You're not going to offset falling gold prices, but those that are low-cost producers will outperform those that are high-cost producers. And then the royalty companies definitely outperform on the falling price.
In this rising gold price, have you lowered your holdings, though, in some of those defensive names and switched to others?
We did last year. Royal Gold was one of our larger holdings. We actually took profits last year when it outperformed, and it's become more attractive as it's lagged the producing companies of late. So it has become a more attractive name to us.
Okay.
We've also...
No, well, I was going to say Rand Gold is one of them, right? A top holding.
Yes, it's a top holding, also a name that we favor. It has a great growth story. They have 2 mines in production now. They're adding a 3rd mine, and they have 3 new projects they'll be adding over the next 5 years, which makes it very attractive.
But political risk, that's always big for these gold miners. They're in these countries that are just politically in turmoil.
Yes, a lot of their
like
mines
the Congo.
are...
Yeah.
Yeah, the Rand Gold, they just recently purchased a company that's in the Congo. They actually have a joint venture agreement with Anglo Gold on that property. And that's something you have to take into account, and therefore we look at risk on our companies, and that's part of our risk metrics that we use.
Okay, Dan, we're out of time, but thanks so much, Dan Denbow of the USAA Precious Metals and Minerals Fund.